The US stimulus may be lower, as you just heard from Rosanna. What would that mean for the recovery in the US and overall market sentiment?
Hi, Matt. Great to be back. What we're watching very closely at the moment is that there seems to be a coordinated messaging from central banks, from governments to taper. Now, this is I don't mean actual rate hikes or actual tapering going on, but they're actually looking over the valley and considering that with the vaccine rollout being successful, they may be in a position to pull back on stimulus or at least reduce the stimulus. We're talking about fiscal cliffs here. We're talking about monetary cliffs right around the world. And the point is that this rally in equity markets and financial assets has been based on a continued supply of global liquidity. Quite noticeable that global money supply topped out in middle of January. That's corresponded with the topping out in global asset prices. So watch that very closely. We may not be getting tapering, but we're also not getting additional stimulus anytime soon, and certainly not at the same rate at which we had last year.
Right, and as a result of that, is that why we are starting to see core pillars of the reflation trade starting to unwind or wane? And where's the money going, and how do you position with all of this in mind?
Well, let's look at some of the core pillars of that global reflation trade. It really was predicated on a weaker US dollar. It was down about 6% the DXY basis last year. And then also we had US real yields falling quite sharply relative to most other trading partners. That appears to be bottoming out now. And as I said, it is corresponding with a topping out pattern in global asset prices or an inability to gain upward momentum. So watch that really closely, particularly with the equity market volatility somewhat elevated at the moment. We're seeing limited signs of contagion to other asset markets, credit and FX, for instance. But watch for contagion. We're worried that a US dollar short squeeze could actually extend further, and that would certainly draw into question the rally in emerging markets, at least in the short term, and then also likewise broader risk assets.